Hey everyone, welcome to our deep dive into Netflix's Q4 2024 earnings call.
Always exciting.
Yeah, we got the transcript right here, and we're going to break down everything
Ooh, fun.
from financials to those interesting moments between the analysts and Netflix's leaders.
Yeah.
So get ready to explore ad strategies,
Yeah.
the whole sports thing, price increases, and the projections for next quarter.
A lot on the table.
Oh, and remember all the buzz around the Jake Paul fight and those Christmas Day NFL games?
I do.
We'll see if those actually move the needle on subscriber growth.
Right.
All right, so let's kick things off with the big numbers.
Okay.
Netflix added a solid 19 million subscribers in Q4,
Wow.
bringing their global total to a pretty impressive 330 million.
That's a lot.
But, it's not all sunshine and roses.
Oh.
While subscriber growth is good, the company's forecasting 12% to 14% revenue growth for 2025.
Hmm.
And that's a bit slower than what some analysts were hoping for,
I see.
especially considering they're projecting to spend around $18 billion on content next year.
Oh, wow. So that's up from 17 billion this year.
It is. It makes you wonder how much more content can they possibly make?
Right. It seems like a lot already.
And that's a question that analysts were asking too.
Oh, really?
Jason Helfstein from Oppenheimer pointed out that Netflix is spending more on content than any traditional media company, but their revenue growth is slowing down.
Interesting point.
He even questioned if there's a point where that content spending reaches an equilibrium,
Equilibrium.
where they don't need to keep increasing it beyond, just inflation.
Okay. Yeah, that makes sense.
So what did Netflix say about that?
Well, Spence Newman, their CFO, argued that they're a long way from equilibrium because of their relatively small view share globally.
Ah,
He highlighted that they're less than 50% penetrated into connected households and are only capturing about 6% of their estimated revenue market.
so they think there's still room to grow.
Exactly. They see significant room for growth, which justifies the continued high content spend.
That's a bold statement considering their stock price has taken a bit of a hit recently.
Yeah, it seems like investors are a little unsure about the long-term profitability of this strategy.
Definitely something to keep an eye on. Let's move on to something that's been generating a lot of buzz, their advertising strategy.
Right, everyone's talking about that.
It's a key area to watch. They launched that ad-supported plan last year, and there's a lot of curiosity about how it's performing.
Yeah, for sure.
Brian Pitts from BMO Capital Markets asked about the learnings and hurdles for ad monetization in 2025.
Okay, so what's the word on the street?
Well, Greg Peters, Netflix's co-CEO, highlighted that the ad plan has been successful in driving accessibility,
Accessibility.
leading to significant growth in their ad user base. And he boasted that engagement for these members remains healthy, which is a good sign for advertisers.
Yeah, that's good news.
But Peters also admitted that while they've met their scale goals for advertisers in 2025, they're now shifting their focus to improving the offering for those advertisers
So they want to make more money.
to increase monetization, basically. Yeah.
So it sounds like they're still figuring things out on the ad front.
They are. They're in the early stages of building out their ad infrastructure and capabilities.
Right.
They seem confident about the long-term prospects, but there's definitely work to be done to optimize that ad experience and maximize revenue.
It's a balancing act, for sure.
Jessica F. Ehrlich from Bank of America asked a pretty pointed question about their ad tech,
Ooh, what was it?
wondering if they have all the necessary tools to really ramp up that ad revenue,
That's a good question.
right? Because Netflix is known for its streaming technology, but advertising tech is a whole different ballgame.
Totally different.
So Peters compared 2025 to the year Netflix transitioned from crawling to walking in the ad space.
Crawling to walking.
Yeah, he talked about their new ad stack, which launched in Canada and is set to roll out in the U.S. in April 2025.
Oh, okay.
And he emphasized that this new stack will allow them more flexibility for advertisers and a better buying experience,
So making it easier for the advertisers.
which should lead to, increased sales.
Yeah. It's all about attracting those advertisers, but it remains to be seen if they can compete with the big players in this space.
Exactly. Peters also stressed that the new ad tech will create a higher quality ad experience for members with more relevance and fewer interruptions.
Less annoying, basically.
Yeah. And he concluded by reiterating their commitment to innovation in advertising and their confidence in continuing to grow ad revenue at a good pace.
It's a balancing act for sure. They need to keep viewers happy, but also make money from those ads. That's not always easy.
No, it's not. Now let's talk about another bold move by Netflix, their foray into live sports.
Right, the Jake Paul fight and the NFL games. Everyone's been talking about it.
It's been a major topic of conversation.
Yeah.
Analysts are really interested to know if this signals a bigger push into sports content.
Yeah, are they going all in?
So Ben Swinburne from Morgan Stanley asked Ted Sarandos directly if those strong NFL viewing numbers made him more interested in full-season sports rights for Netflix.
I mean, those viewership numbers were impressive. Over 30 million viewers on average for those games. That's got to be tempting for them.
It is. Sarandos acknowledged the phenomenal viewership, but he said the economics of full-season big league sports remain extremely challenging.
So not a no, but not a yes either.
Right. He said they'd explore it if there were a way to make it work for both Netflix and the leagues, but for now they're focusing on live events with sports as part of that.
So a cautious approach.
Yeah, but pragmatic. They're not ruling out major sports acquisitions, but they're not jumping in head first without a clear path to profit.
Smart move.
Speaking of other sports ventures, Rich Greenfield from Lightshed Partners asked if the Jake Paul fight and WWE Raw results had influenced their decision process on something like UFC.
UFC, that would be huge.
It would be. Sarandos shared that WWE Raw has been a success, drawing double the audience of Monday Night Raw on linear television.
Double. That's impressive.
And he also highlighted the strong international viewership growth, a 25% increase in non-live viewing the day after the event.
So people are watching it even after it's live.
Exactly. It seems like they're seeing some early wins with live sports and events, which could make them more open to bigger deals in the future.
Maybe UFC isn't so far-fetched.
But Sarandos reiterated the importance of favorable economics for any potential deals. He said they want to bring value to the sport like they've done with WWE and the NFL, but that has to be reflected in the deal.
So they're not just throwing money around.
No, they're being strategic. And to round out the sports discussion, Vikram from Baird asked about their decision to acquire the rights to the FIFA Women's World Cup in 2027 and 2031.
The Women's World Cup. Interesting.
Sarandos said it fits perfectly into their strategy, highlighting the growing interest in women's sports and the event's status as a real TV event.
Definitely a growing market.
And he also expressed excitement about having the time to start telling the stories of these teams and athletes through documentaries and series.
That's where Netflix excels storytelling.
Exactly. That's where they can leverage their expertise and potentially differentiate themselves from traditional sports broadcasters.
Makes sense. Okay, so we've covered subscriber growth, advertising, and scoots. What about their core content strategy?
Right. Rich Greenfield brought up the success of the film Carry On, which racked up over 313 million viewing hours in less than 2 months, and that's without a theatrical release.
Yeah, that's impressive.
He asked if this proved that movies can break through on Netflix alone.
Skipping the theaters altogether.
Exactly. So what did Sarandos have to say about that?
He was pretty enthusiastic, called Carry On, a great example of a movie born on Netflix generating a huge audience and tons of buzz.
He emphasized the modest marketing spend, suggesting that the buzz built organically through the power of the Netflix platform.
So they believe in their platform.
They do. It seems like they're doubling down on that direct-to-streaming model and believe they can create blockbuster hits without relying on theaters.
Interesting. But they're not completely abandoning theatrical releases, are they?
You're right. Doug Amos from JP Morgan asked about their agreement to debut Narnia in theaters in 2026, wondering if it suggested a change in strategy.
So what's the deal with Narnia?
Sarandos clarified that there's no change to their core strategy of giving members exclusive first-run movies on Netflix.
Okay.
He explained that the Narnia IMAX release is a tactical decision for awards qualification festival requirements and publicity.
So strategic releases for specific purposes.
Exactly. Not a core part of their distribution strategy. Now let's talk about everyone's favorite topic, price increases.
Ah, the dreaded price increases.
Michael Nathanson from MoffettNathanson asked how Netflix plans to approach price increases moving forward, particularly in their largest markets.
This is a sensitive topic for any streaming service.
It is. Greg Keeter said their pricing philosophy hasn't changed. They're focused on providing more value to members through content investments, and they listen to member signals like engagement retention and acquisition to determine when they've achieved that value increase.
So it's data-driven.
Exactly. Peters pointed out that they've successfully implemented price increases across various markets in EMEA, APAC, and LATAM over recent quarters.
They've been doing it gradually.
And he emphasized that their starting price of $7.99 in the U.S. for the ad-supported plan is an incredible value and a highly accessible entry point.
Right. So they're positioning themselves as a value-driven service.
But it's clear they're not afraid to raise prices when they feel it's justified.
They're a business after all.
And Ted Sarandos chimed in to add that they're going into 2025 with a strong content slate, implying that further price adjustments might be on the horizon.
So we might see more price increases in the future.
It's definitely a balancing act. They need to keep prices competitive while also generating enough revenue to fund that ambitious content spending.
A tough spot to be in. Okay, so we've covered a lot here: subscriber growth, advertising, sports price increases. But before we dive into the financial details and the next quarter guidance, I have a question.
Okay, what is it?
We've heard about their confidence in ad revenue growth and their willingness to raise prices. Do you think those two things are connected? Interesting question. Could we see Netflix become more aggressive with pricing on their ad-free plans as their ad business takes off?
That's a great question. It's certainly possible that they could use their ad-supported tier as leverage to push up the price of those premium plans.
Right, because they can always point to the cheaper option.
And it would be interesting to see how consumers react to that.
Yeah, would they be willing to pay more for ad-free, or would they switch to the ad-supported plan?
Lots to think about. Let's dig into those financial numbers and see what insights we can glean about their overall health and future prospects.
Sounds good to me.
Welcome back to our deep dive into Netflix's Q4 2024 earnings call. We just finished dissecting their content and strategy, so now it's time to get into the nitty-gritty, their financial performance.
Let's dive in.
Starting with engagement. This came up again and again in the analyst Q&A.
A hot topic for sure.
Right. Peter Supino from Wolf Research asked directly if engagement growth is a strategic priority for Netflix.
So is it?
And Ted Sarandos answered with a resounding, absolutely. He emphasized that Netflix's goal is to entertain the world, and they measure that by how much people are actually watching.
Makes sense.
Sarandos pointed out that their average member is watching for about 2 hours a day,
Yeah.
but he sees room for growth.
There's always room for more.
Right, considering people streamed an estimated 200 billion hours of programming last year, Netflix wants a bigger slice of that pie.
Naturally, they're not content with just maintaining their current levels.
It's a competitive landscape,
Yeah.
and they know they need to keep viewers glued to their screens.
Absolutely.
Greg Peters added that they see a strong correlation between engagement and key business drivers like retention and acquisition.
The more engaged someone is, the more likely they are to stick around and maybe even recommend the service to others.
Right, and Spence Newman chimed in to emphasize the role of engagement in their flywheel. He described it as a cycle where engagement leads to revenue, which leads to profit, which fuels more investment in content.
It's a clear articulation of their business model. Engagement is the engine that drives everything else.
Speaking of engagement, they're actually changing how they report it.
Oh, really?
Neumann reminded everyone that their next engagement report is coming out in February.
No.
And starting with their Q2 report in July, they'll be including engagement metrics in their earnings reports.
So more transparency.
It sounds like they're taking engagement very seriously and want to be open about how they're measuring it.
Yeah.
Now let's talk about a challenge that every long-form content provider is facing these days: short-form video.
TikTok, Instagram Reels, YouTube Shorts, it's everywhere.
Right. Justin Patterson from KeyBank asked about how Netflix plans to compete with platforms like TikTok for engagement.
It's a valid concern. Those platforms are incredibly popular, especially among younger audiences.
Yeah, those who crave bite-sized content.
Exactly.
Sarandos acknowledged that they need to appeal to these younger viewers. But he emphasized that Netflix will remain focused on professional, longer-form storytelling.
They're sticking to their guns.
They're not going to abandon their core competency, and they believe there's still a huge appetite for high-quality movies and TV shows.
I think they're right.
Greg Peters added that Netflix sees itself playing a specific role in the entertainment ecosystem, providing a curated experience of great movies and TV shows. They want to be the destination for both creators and viewers who value that kind of experience.
It's a smart strategy. They're acknowledging the rise of short-form video while carving out a distinct space for themselves.
Now let's shift gears to another area where Netflix is experimenting: gaming.
Right. They've been talking about this for a while.
Doug Cruz from Cowen asked about their progress in the gaming space, particularly about engagement trends and the impact on subscriber growth and retention.
So how are those games doing?
Greg Peters shared that they've learned a lot and highlighted some successful titles like Oxenfree 2 and Squid Game Unleashed. He emphasized that they're focusing on games based on their popular IP party and co-op games and kid-friendly titles.
Leveraging their existing IP makes sense.
Right. It allows them to tap into those built-in fan bases and create synergy between their different content offerings. Peters also revealed that they're already seeing a positive impact on acquisition and retention from game-playing members.
So it's working.
However, he admitted that those effects are still relatively small.
Early days.
It'll be interesting to see if they can grow that segment and make gaming a more compelling part of their overall value proposition.
Definitely something to watch.
Peter stressed that they're being disciplined about their gaming investments and will scale them as they see continued growth in member benefits.
So they're not going all in just yet, but they're keeping an eye on it.
Exactly. Okay, so we've talked about engagement competition from short-form video and their gaming strategy. Now let's get back to the numbers.
Get to the bottom line.
Netflix reported that their ad revenue doubled year over year in 2024.
That's impressive. But what does that actually mean in dollars?
Well, they haven't released exact figures yet,
Uh-huh.
but they're projecting that ad revenue will double again in 2025.
So it's gaining traction.
It sounds like it, but is it enough to offset the slowdown in subscriber growth and the increasing content costs?
That's the big question.
Speaking of dollars, what's the story with their overall revenue?
They're forecasting 12% to 14% top-line revenue growth for 2025.
Healthy growth, but as we mentioned earlier, it's a bit slower than what some analysts were expecting.
Investors are starting to wonder if Netflix can maintain its historical growth rate.
Now let's talk about profitability. What's the outlook for their operating margin?
They're expecting it to improve in 2025.
So they're projecting to become more profitable. How are they planning to do that?
Spence Newman explained that they're expecting slower expense growth than revenue growth.
So they're keeping a tight rein on those costs.
Exactly. Newman highlighted that they'll be focusing on disciplined spending, particularly in areas like content amortization, product and engineering, and their ad sales organization.
Trying to strike a balance between investing in growth and maintaining financial discipline.
A classic balancing act.
Now let's circle back to that question about content spending. Jason Helfstein from Oppenheimer asked if there's a point where Netflix reaches an equilibrium and doesn't need to increase spending beyond inflation.
Is there a limit to how much content they can create?
What did Spence Newman have to say about that?
He argued that Netflix is a long way from equilibrium, pointing out that they're still relatively small in terms of view share and penetration globally.
So they believe there's still a lot of room for growth.
And they're willing to keep spending to achieve it.
But that comes with risks. What if subscriber growth keeps slowing? What if the ad market softens?
Valid concerns and questions analysts will keep asking.
Now about their operating margin, John Blackledge from TD Cowen asked about the drivers behind their raised 2025 operating margin guidance.
This is where we see their focus on financial discipline in action.
What did Newman say about the margin improvement?
He attributed it to their projected high single-digit expense growth, which is still below their projected revenue growth.
Expenses are going up, but not as fast as revenue.
Precisely. And Newman broke down their expense growth, highlighting high single-digit content amortization growth investments in product and engineering for things like ads, live content, and games, and investments in their ad sales and marketing.
It's clear they're trying to optimize their spending and drive efficiency. But they're also facing pressure to keep up with the competition and deliver a compelling content offering.
It's a tough balancing act for sure.
So to sum up their financial performance, they're projecting solid revenue growth, but slower than some analysts were hoping for.
True.
They're also focused on improving profitability and are taking steps to control costs.
Right.
But their heavy content spending and reliance on subscriber growth and ad revenue raise some questions about the long-term sustainability of their business model.
It's a complex picture.
And it's one that we'll continue to analyze as we move on to part 3 of our deep dive. All right, welcome back to the final part of our deep dive into Netflix's Q4 2024 earnings call. We've covered a lot of ground, from subscriber numbers to content strategy to their advertising push and their foray into live sports.
Ooh, it's been a journey.
Now it's time to step back and consider what it all means. What are the big takeaways?
We've seen a company that's still growing but facing some real challenges.
For sure. Their revenue growth is slowing, content spending is sky high, and they're betting big on new initiatives like advertising and gaming.
Right, and let's not forget the competition. New streaming services popping up all the time.
So the big question is, can Netflix maintain its dominance in the streaming world?
That's the million-dollar question. What are investors thinking?
And this earnings call provided some clues, but also raised some new questions.
It always does.
Let's start with their guidance for next quarter. They're projecting to add 9 million subscribers in Q1 2025.
That's a significant slowdown from the 19 million they added in Q4.
It does suggest that their growth might be plateauing, at least in the near term.
The law of large numbers, perhaps?
Maybe. Now let's talk about their long-term strategy. It seems like a multi-pronged approach.
Many irons in the fire.
They're continuing to invest heavily in content, building out their ad business, dipping their toes into live sports, and experimenting with gaming.
It's a lot to manage.
It is. And it's not clear if all these initiatives will be successful,
Some will hit, some will miss.
right? Their success in advertising will be crucial. If they can generate significant revenue from ads, it could help offset the slowing subscriber growth and those rising content costs.
It could be a game changer.
But as we talked about earlier, they're still in the early stages of building out their ad infrastructure.
They need to prove they can attract advertisers and provide a good ad experience for viewers.
And then there's the question of live sports.
Yeah.
They've had some early wins with events like the Jake Paul fight and WWE Raw.
But are they willing to pay big bucks for full season rights to major sports leagues?
That would be a huge change, and not without risks.
Those sports rights are expensive. No guarantee they'll bring in tons of new subscribers.
Exactly. And then there's gaming. They're seeing some positive early signs, but it's still a small part of their business.
It'll be interesting to see if they can make it a more central part of their offering.
So overall, Netflix is at a crossroads.
Just turning point.
They're facing big challenges, but they're also pursuing ambitious new initiatives.
Definitely a company in transition.
The next few quarters will be critical in determining their long-term trajectory.
Nail-biting time for investors?
One thing that stood out to me was their confidence in their ability to raise prices.
They've done it before, and they seem to believe they can do it again.
But with so much competition, how much further can they push it?
It's a delicate balance, trying to maximize revenue without losing subscribers.
Which brings us back to the big question: can Netflix maintain its dominance in the streaming world?
The crystal ball is murky.
This earnings call gave us a peek into their thinking and plans for the future.
A glimpse behind the curtain.
We've seen their strengths, their weaknesses, and their vision.
It's fascinating to see how they're adapting to this constantly changing market.
And it leaves us with plenty to think about as we wait for their next earnings report.
I'm curious to see how those ad revenue and engagement numbers look next time.
Those will be key indicators of whether their strategy is working.
And of course, we'll see if they make any big moves in live sports or gaming.
It's an exciting time to be following Netflix.
We'll be here to break it all down for you.
Thanks for joining us on The Deep Dive. We hope you enjoyed this deep dive into Netflix's Q4 2024 earnings call.
Always a pleasure.
We encourage you to keep exploring these topics and share your own thoughts and insights. Until next time, stay curious and keep diving deep.